Well, hi, everybody, and good afternoon or good morning, wherever you may be. Thank you for joining us for one of our first EIX.org new podcast format podcasts. We're very excited. We have Ann Winblad with us today, managing partner of HWVP. And Ann, I think we're ready to get rolling.
Hi, I'm Ann Winblad. I've been asked to talk about a few things today: my career, venture capital, and entrepreneurship, and my role as a woman in both as an entrepreneur and as a venture capitalist. So let me start with talking about my career a little bit. I started my career after I graduated from St. Kate's and St. Thomas as a systems analyst at the Federal Reserve Bank of Minneapolis. I thought it would be a great job until I discovered we were all trying to use the same mainframe at the same time. Yes, I worked on a mainframe computer. So I proposed that we work flexible hours. I brought the proposal to my supervisor. My supervisor brought it to the vice president, who said, no, we couldn't do it. Well, I went back to my group and said, they said we could do it. And we had a secret project. At the end, my group had better productivity than everyone else. The bank vice president then thought it was a great idea, took credit for the idea, and I resigned. That was my first no. So I left the Federal Reserve Bank and started my own software company, convincing 3 programmers to join me from the Federal Reserve Bank, because I was a young, 1 year out of college programmer. Those 3 programmers were much better than me. At some point, I needed to raise money. Venture capital in 1976, the year Microsoft started, the year Apple started, and Oracle would start a year later, was not really out there for software companies. Nobody actually knew what software companies really were. So I needed $25,000 to buy computers for my programmers. In Minneapolis and St. Paul, there were 10 banks. I made a list of all 10 of them, and one by one, I went to all the banks. I was at the 10th bank, and 9 banks had said no to me already. I had a great business plan. I thought my presentation style was great, but yet I got no's. So I went home and practiced crying in front of a mirror. And when I got to the 10th bank, just as the banker was to say no, I burst into tears. And I believe I walked out of that bank with $25,000 and the banker's arm around my shoulder, thinking I was his young daughter. That was the second no that shaped my career. Open Systems was a very successful software company. It became the 16th largest software company in the US. So I started Hummer Winblad Venture Partners with my partner, John Hummer. John is 6'10", I'm 5'2". We were very noticeable when we went out and raised capital. And we thought it would be easy to raise the first venture capital fund focused on software. 133 meetings later, 133 investors said no, they would never invest in a venture capital firm focused on software. Now, most people would be pretty depressed after 133 no's, but for me, it was my 3rd time that no was going to shape my career. Finally, we went back to Minneapolis and went to 3M Corporation, who became our first investor. 3M called IBM, who became our second investor, and pretty soon we had our first fundraise. So I grew up the valedictorian in my class, a really very good honors. I graduated from St. Catherine's, a master's degree from St. Thomas. So I was used to getting yeses, but it was only these 3 no's that have shaped my career. I'm an unlikely venture capitalist. Today, this chart shows that 18% of venture capitalists are female. That's a very exaggerated number because only 8% of the partners are actually female. I happen to fit into the 2nd bucket in the largest category. But the 3rd bucket is one people forget about. Most of the venture capitalists went to Harvard or Stanford or one of the other Ivies. I always call St. Thomas the Ivy of the North because it's a beautiful campus, and say that I graduated from Ivy too. But as you can see here, if I had known this ahead of starting a venture capital firm, I might have been, again, pretty depressed. But I've not been. I've really had a fantastic 29-year career as a venture capitalist. So we started our fund in 1989 after 133 turndowns. We were the first venture capitalist focused solely on software. We're called a focus fund, meaning we only do one thing. We focus on enterprise software Software is sold directly to businesses, and we start with a seed or Series A. We started over 150 new software companies where we've led the first investment as a venture capitalist, and our performance has been a 42% internal rate of return that's net of management fees and any other fees, which is an extraordinary result for a venture capital firm. Venture capital is interesting, and of course those 133 investors that turned us down were totally wrong about software. This year there'll be about $100 billion invested in venture capital across the world, and over 40% of that will be software companies. A big change is most of this venture capital used to come from Silicon Valley, but venture capital is becoming much more distributed, global, and in fact, for the first time this year, less than 50% of venture capital is coming from the US. So the good news is venture capital is becoming more distributed. The challenging news is competitors are everywhere. When we look at venture capital was capital that went to high-risk, early-stage companies. But what's happened in the marketplace in the last couple of years, if you look at this chart, even though it will be a record year for dollars going into venture capital, about $100 billion, it will be an all-time low for startups. That means that money is pouring into companies that are breakout successes, not just from venture capitalists, but from private equity and sovereign wealth companies as well. So it is harder and harder for companies to get their first round of venture capital. But it does mean that those are very cherished companies should you be able to secure that money. And again, this slide illustrates that over the last 8 years, as you can see, the amount of money going into early stage companies is getting smaller and smaller. So when you take this number, you can see that the number of companies is back to 2010 levels. Globally, only about 4,000 companies per year will get their first round of venture capital or get venture capital from a venture capitalist. This means that all of you, if you're looking to start a company, also need a plan B. What do you do if you are not one of the 4,000 companies across the globe that cannot secure venture capital? How do you secure angel money or other funding that is not from the venture capital world? So what's happening here is what you read about. Unicorns are booming. You read about companies like Airbnb, Uber, Lyft, or even all the scooter companies across the globe that are getting companies. But you don't read about the startups until they've broken through. And again, when we talk about venture capital, it's not always equal. Here, my home state of Minnesota last year got $565 million from venture capitalists. California got $43 billion. So it also says you have to know where the money is and go to where the money is. I encourage entrepreneurs in states that only get $565 million to trek out to California and make their presentation where there's a larger group of venture capitalists to be one of these 4,000 companies per year that does secure venture capital. Why are there so few startups getting money? Because success is challenging. For every 1,000 companies that receive angel or seed investing, only 400 of those companies get a Series A from the venture capitalists. Then again, if you get your Series A, only half of those companies move on to get a Series B. It gets a little better after that. Once you get to your Series B, you have a strong likelihood of getting to a Series C. And if you get past that, that's when all of that later stage money from both venture capitalists, private equity, and sovereign wealth tends to rain on you. So getting to the finish line requires that you actually get to that Series C. 92% of companies that are acquired after their Series C. So not only do you have to make the gauntlet of getting through your Series A, but you have to get through a Series B and through your Series C before you would achieve any liquidity event. And liquidity event, by that I mean you're on your route to becoming a public company, or you're being acquired for cash or stock in another company. So building a unicorn is hard. I'm going to talk in a minute about one of our recent unicorns, a company called MuleSoft. So you can see the dynamics of building one of these companies from scratch. This is another funnel. The previous one was 15,000 companies to get the statistics I showed you. This shows 1,000. By the time you get to unicorn status, there are only 20 companies that make it to those very high, very well-pressed companies you read about in the wires. So MuleSoft, this is a typical Hummer Winblad Venture Partners HWVP investment. The company went public as an 11-year-old company. Again, this takes time. The typical company that goes public is 9 to 10 years old. The typical company that gets acquired is 7 years old. That's how long it takes to get from your Series A to your Series C. This company did not take seed round investment. They used what was called a freemium model or open source model, actually giving their software away to seed the market. We heard about this company through a research analyst. This company had done a great job of briefing these research analysts about who they were. The company had 5 people. The visionary founder was in Malta. 2 employees were in Buenos Aires, Argentina. 1 was in Germany and 1 was here. This is very typical of a startup these days. Not everybody is in one place, and we would never conceive of funding a company in Malta. So the company did incorporate in the US and base their corporate office here in San Francisco. So there were 5 people, 4 countries. They had some customers that were using the product for free, but no revenue. So don't think that you have to establish revenue guidelines or you go too far before you go out to get that Series A. They had a very well-defined market position going after older competitors who had not updated their product for about 20 years. Their competitors were not small. They were IBM, Oracle, and a large public company, newer, called TIBCO. Again, we syndicated the A round, so there would be 2 investors involved here. That's 2 pockets helping you get to your next round of investing. And by the time the company went public in March of 2017, they had well over $100 million of revenue. So again, the bar to become a public company is very high. They turned down any offers of acquisition along the way because they believed that their market opportunity was substantially large. 1 year later, this spring, Salesforce approached the company to acquire them and purchased the company for $6.7 billion, which until recently was the largest multiple valuation for any enterprise software company. So why the steep drop-offs, and why isn't everyone a MuleSoft? Why can't everybody get to their Series C? There are some main reasons. First, teams. They break up. You might not have the right team or the right CEO. Talk about all of these in a minute. Next, you don't raise the right amount of cash, and you don't have any plan B in place. What if the cash doesn't go as far as you think? What will you do? It is really, really hard to just suddenly fire employees if you haven't thought about what are you going to do to lower your cash burn if you can't get as far as you thought. Third, you have a product and not a real company. This is the harder one to detect. Even for us as investors, we like to believe that companies are going to scale, or your business model assumptions are not valid. Last, something out of your control is your whole sector was overinvested. Everybody invested in a similar company to you. The sector becomes commoditized, no one has competitive advantage, and no one succeeds. And last but not least, you had bad luck. And yes, luck does matter. So I talked about themes. They drive many early stage investments. These are the areas that are overcrowded. It's great if you're part of these themes because you might get an investment immediately, but also you'll be in the most competitive sectors ever. Right now, these are some of the recent themes. So if you are in these thematic investment areas, make sure you get investors that have invested thematically and have been able to build breakout companies within those themes. So finding your investors. We'll use a baseball analogy because it is the World Series time right now. You need to find the right batter to pitch to. And Warren Buffett, who's the most successful batter in the universe and investor, says we only swing at strikes. As I said earlier, we invest only in enterprise software companies. You'd be surprised how many calls or emails or texts I get saying, I'm a consumer software company, will you fund me? That means A, they haven't read our website, B, they haven't looked up who are the target investors in their sector. They could read Crunchbase and see exactly who we are investing. Or you could look up similar companies in Crunchbase and find out who's investing in the consumer or retail or ag tech or fintech sectors. There is a wonderful site called CB Insights that also gives you mapping of all the investors in very specific segments. If you search for CB Insights and ag tech, for example, it will show you all the investors in that space. Corporates are also in 23% of all deals. So don't count out the fact that a corporate investor may be your lead investor, not likely at the A round, but perhaps at the B or C round. Also look at the partner, not just the firm. Once you find the right firm who is investing in your sector, who's had success in your sector, who you will be informing versus educating about what you are forming. Look at the partner that also is the best fit. And look at who's been funded already. Call up another entrepreneur that's been funded by this firm. Entrepreneurs like to help other entrepreneurs. Ask that entrepreneur if they will make an introduction for you. Ask that entrepreneur if you can give them the pitch ahead of time and see if they think it will actually be a good pitch for that firm. So find the right batter to pitch to in the beginning. Don't waste your time. Know the market. Warren Buffett also says the market bats last. It's important that you captivate versus inform. If you're just informing the investors of what you have, that means we don't know enough about the segment. And what does that mean? We funded a company called Hyperion many years ago. It's a very large sector of Oracle right now. Company went public and was acquired by Oracle. The two entrepreneurs came in and they unfurled a scroll in front of us that had the name of 500 customers. They said, we called all 500 of these customers, call any of them, and they will tell you that the market needs this. Now, I don't recommend theatrics for everyone, but it was a way to captivate us right away versus to just slog through a slideshow. Tell us what the customer wants, not what you are building. Don't talk about the functions and features of your product. That's for angel investors. They fund products, we fund companies. Show off your team. There should be at least two of you. One of you should not do all the talking. And size up your market. If you don't know how to size a market, go to the S1 or the IPO prospectus that similar companies have filed. If you're in the enterprise infrastructure area like MuleSoft, read MuleSoft's S1. All public companies or newly public companies are required to size their market and explain how they came to that sizing. So likely somebody's already sized up your generalized market for you. Define your business strategy and build a business for a large unmet market need. We like greenfield opportunities where there's lots of risk and lots of opportunity. We need to know what your key assumptions are. Now remember, as a young company, you won't have facts. You'll only have assumptions. Our job is to look at those assumptions. What is your revenue strategy? How do you land into a customer and then expand? When will multipliers kick in for this business? What are the competitive dynamics? How do these assumptions drive headcount? I always recommend reading Michael Porter's Competitive Advantage. There is one chapter in there, and while you're students, you should read it now because it is very textual. It is called Understanding the Value Chain. That has you define your key assumptions. As a young entrepreneur, I wrote 10 assumptions on a whiteboard, and once a month I looked at them. If they were still true, I said to my team, let's keep on doing what we're doing. If one of them was untrue, we all huddled together and said, that strategic assumption will never turn into a fact. What do we have to change about our business? That could be your pricing strategy. That could be your competitive dynamic. That could be your go-to-market strategy. But just build that small set of assumptions and look at them. Because you will find as an entrepreneur that you will have your nose to the grindstone, you'll be in a hamster wheel of activities, but you cannot lose track of your business strategy. You also have to determine how much money you need. So you have to understand what are your next risk reduction milestones. When we fund an A round, we say, how much money will it take to get you to a point of greater value? In the case of MuleSoft, that point of greater value was, when will you have customers that have actually paid for the software and have paid the same purchase price and have paid for the same value proposition? When will customers speak for you versus you speak about the customers? Usually in the enterprise software space, that is about 18 months of operating, give or take 6 months. Now that risk reduction milestone means that you were more valuable than when we funded you, when you didn't have paying customers, when only you could talk about the customers. And also, back to those 10 assumptions, some of those assumptions have now become facts. So handling the process. This is also a real challenge for entrepreneurs. Go to where the money is. Once you find out who your target investors are, you could be in Minnesota, they could be in Georgia, they could be in Boston, they could be in California. You have to go to where those target investors are. Feedback will not be consistent. Everybody has a different lens. It'll also take time. Be prepared for a term sheet. Excuse me. Be prepared for a term sheet. What that means is that you will get a technical document called a term sheet, which will be very legalese. It will talk about what is preferred stock, what are preferences of that preferred stock, how is your board constructed, how many people will be on the board, what are the voting rights for certain things like procurement of your office, for example. So have a lawyer set up with you who goes through a term sheet before you ever get one. And clean up your capital structure before going to a VC. If you sold little bits of your company to multiple angels and you have a capital structure, meaning ownership structure, which is very, very hard to build a VC round about, you will get a no, because we'll have other opportunities that will be cleaner capital structures. And if you don't understand what a capital structure is or a cap chart is, that is also something you should sit down with your lawyer. So the takeaways here for you as an entrepreneur is that you have to view uncertainty and complexity as signposts to a great opportunity. No should not be depressing to you. No should be the ultimate challenge. You always need to see the glass as half full. If you're not a glass half full person, you shouldn't be an entrepreneur. You need to study business models. Products are easier to build than businesses. And leverage your network. If you looked on LinkedIn for UST, my alma mater, graduates, you would find 72,000 results. Use your network. Thank you very much. I guess we'll go to questions now.